Our last segment today is a technical subject, very technical and exciting because we're talking about finances and investment. And we're very lucky to have the CAO of the Municipal Finance Authority here. The presenter will be Peter Urbanc, the CEO of the Municipal Finance Authority, and also his guest, Doug Spindler, the Assistant Director of Treasury Services for the City of Burnaby, to share his practical insight as well. Given the limited fixed income investment options traditionally available to local governments, MFA has introduced several new investment options over the last few years and is planning on introducing a brand new investment fund in 2021 that will, for the first time ever, invest in global investments across multiple asset classes, including equities. To explain more about the details and what possibilities and questions this type of investment opens up for local government, here's Peter Urbanc's presentation.
Good afternoon. This is Peter Urbanc. I'm the CEO of the Municipal Finance Authority of BC, and I'm joined today by Douglas Spindler, who is an assistant director and manages investments at the City of Burnaby. We've been talking about this topic for the last few years at the LGLA, but this is finally going to come to fruition. We're working on a very interesting investment product that many local governments will be interested in, and we thought it was very important to walk you through some of that process and some of the considerations you will need to do at your local government before investing in this new product. As a disclaimer, just mentioning here that any of the comments in here are not the opinion of the Municipal Finance Authority of BC or the City of Burnaby. There are personal opinions. We believe them all to be correct, but we want to just point that out. So let me just kick it off with a quick overview of the Municipal Finance Authority of British Columbia. Most of you know who we are. Our two main products are long-term and short-term lending to local governments in BC. So in BC, we have this unique opportunity, I would call it, to use the Municipal Finance Authority of BC to borrow in the capital markets as a very highly rated, AAA rated entity. And then we lend that money to local governments in BC at the lowest cost available to any local government in Canada. So quite a great thing we have here in British Columbia. But what we're going to talk about today is the last row down here, the pooled investment products. Those are products that we offer that your local government does not have to use. You can manage your investments on your own. But through the Municipal Finance Authority, we can create more interesting and instantly diversified, professionally managed investments that you can put your reserves into. And in particular today, we're going to talk to you about the Municipal Finance Authority Pooled Growth Fund, which we hope to have available for local governments by the end of this year. We've been talking about this for several years. What we've seen happen in the United States and across Canada over the last many years are various local governments allowing, or various provinces allowing their local governments to not just buy bonds, fixed income investments and deposits in banks as assets for investments, but they're allowing other types of global assets, such as stocks, equity securities. And so those options are available already in many jurisdictions in Canada, including Ontario most recently, but they have been available for quite some time in Alberta, Saskatchewan, and Nova Scotia. And the idea behind this, you may think to yourself, geez, stocks are probably not a good investment for a local government. But if you think about the traditional, what reserves were traditionally, reserves have been traditionally way back when were there as emergency cash if things unexpected happened. But over time, local governments in BC and across Canada have grown their reserves to quite substantial amounts, and they are attaching those reserves to long-term capital spending or other long-term needs. And so given where interest rates are today, we really feel at MFA and the City of Burnaby itself that these new types of products should be available. However, the reason we're talking to you today is that for many of you, it will require quite a bit of thinking, perhaps changes to some of your internal processes and policies before you even consider going into this type of a product. So what can local governments buy today? Effectively, they can buy this list of securities, which are bank deposits, government bonds, both provincial, municipal, and federal bonds. And the second item you see there are you can purchase pooled investment funds managed by the MFA. And so that's what we're going to talk about today. This idea that currently we only offer you bonds through those pooled investment funds, or you can only buy bonds through the other things you can buy yourself directly. But we're going to now be creating a class that's diversified, a pooled investment class that's very diversified, but that does invest in higher risk assets. As I said, those things are already available in many parts of Canada. I'll pass it over to Doug, who will talk to you about Burnaby's experience with this idea.
Thanks, Peter. For the last 5 to 6 years, as Burnaby's portfolio grew, we continued monitoring what was happening in the markets. That includes the historic and future returns amongst the various asset classes and the changes to investment rules occurring across the provinces for local government investments. Recognizing that the community charter is a prescribed methodology for investing and limited to only 2 asset classes, and recognizing that Canada represents less than 3% of the global economy, the discussion to council and ultimately the resolution submission to UBCM was and is still about long-term sustainable growth and investment opportunities to support sustainability. The resolution was passed at the September 2019 UBCM conference, which meant a response from the ministry was required. The response was issued in February 2020. In short, the response was that there will be no change in the charter and local governments have the MFA to support and provide for our needs. Fast forward to the current day and the many discussions and activities that have occurred, including today's presentation, has been about a diversified asset class growth fund. So let's take a look at standards rules for investing. Next slide, please, Peter. For a local government, or any investor for that matter, there are really some basic components that should be in place prior to making investment decisions. So whether you have a dedicated investment manager who invests in various products directly, or you invest strictly in MFA pooled funds, or you have a combination of both like we have here at the City of Burnaby, this list provides some basic concepts. Do you have a 12-month rolling cash flow projection? Everything in Treasury starts and ends with a cash flow. And you can't consider investments and timeframes until you know when and how revenues and expenditures flow and when they are needed. Can you match long-term capital needs with various investment products? And if you can, what risks are acceptable and what analysis has been conducted on where we are in the current economic cycle? What does this mean for your time frame and returns? Diversification of your portfolio can protect from systemic and guarantor risks, but you also must consider interest rate risk, inflation risk, liquidity risk, and investment risk, for example. And when you have all these components in place, obtain pricing from multiple sources, the broker, the dealers, to compare their prices, and even talking with other governments can be important to ensure you're not overpaying for a product. This can add up in savings or additional costs in the long run. The reason you diversify is to ensure appropriate liquidity while you stick to your investment plan. Sure, there are changes that occur as the investment world is dynamic, and yes, investment plans require an ongoing cycle of review and adjustment, but this is completely different from panic trading and knee-jerk reactions, which stems from, poor planning. And while basic steps, these rules are essential for long-term sustainable growth for both the portfolio and the local government. Most of you have seen this data in one format or another. Achieving stable fixed income returns consistently over the last 30 plus years is contributable to a tremendous bond bull run. But when you are at the historic low interest rates like we are today, then what? What do? Understanding where we have been and where we are will allow you to understand the risks ahead. And as you predominantly invest in fixed income products, what do interest rates look like if you executed a long trade now? Let's take a look at an example on the next slide. So the City of Burnaby goes into every long-term fixed income product with one decision in mind. and that is to buy and hold until maturity. Based on many factors, we decide if risk, meaning the issuer and the term to maturity, is commensurate with the return, meaning the yield. So our analysis conducted determines if we are going to invest for 10, 20, or even 30 years at the interest rate being offered. If yes, we do so through a buy and hold strategy. Do we ever sell along the way if it is advantageous to do so? Absolutely we do. But there are conditions in which selling may not be an option, so you need to be sure of your cash flows and projections first and understand where that risk lies and be able to determine if you can hold the note until the maturity date. Using Ontario's as an example, which the city owns approximately 100 million of their notes, ranging from 3 to 6%, buying such a bond today for 10 years, we would consider as risky as equities or other asset classes. As shown in the chart, if we purchase a 10-year Ontario bond today, we would earn 1.4% over the 10 years. Is this acceptable? If interest rates move up just 1% in the near future, the value of our holdings has decreased by 8%. If this occurs, the only option is to hold until maturity. To us, this is too high of a risk for the reward. So we will look for alternative investment options, including holding short-term investments until market conditions change, and that could be a while. So let's take a look at the balance and yield. This slide is pretty straightforward and shows the City of Burnaby's total reserve balance growth over the last 20 years and the portfolio yield over the same time frame. The orange line details the growth of the city's reserves growing from 220 million at the end of the year 2000 to over 1.8 billion at the end of 2020. The city's portfolio yield on these reserves is tracked on the blue line. The city held an annual yield of 6.04% in 2000 and a yield of 2.82% for 2020. But now we are projecting a yield of just 2.25% for 2021, as we are mainly a prescribed portfolio. But what this chart also shows is that with fixed income investing, even long-term and on the right side of a historical yield curve, you still have plenty of risk. When quantitative easing is put into place and interest rates plummet, like what has happened since March, maturing investments are being reinvested at substantially lower yields. 5 and 6% maturities or sales are now reinvested at 1.5%, maybe 2%, maybe lower. And new funds are going into low-yielding short-term products as well. So for long-term sustainable growth, the objective is to utilize long-term reserves through investments with appropriate risk-adjusted returns and greater diversification, which in return actually reduces various investment risks that we discussed. It is for these reasons we are working with the MFA so closely to introduce the Growth Fund. Over to you, Peter.
Thank you, Doug. So Doug has walked you through some of the risks involved in fixed income investing. As he mentioned, if you buy a fixed income instrument and hold it to maturity, you're not necessarily taking on a lot of risk, but your investment does change in value. So this graph here just looks through a little bit of the risks involved when you compare bonds to stocks, when you look at it over 1 year periods. So in green here, you have the TSX, so all the Canadian stock market. You have rolling 1 year period returns, meaning that on a specific date, the number that you see there represents the last 12 months of returns for owning all of the Canadian stocks in the Canadian TSX index. Conversely, you can own all of the bonds, all of the public bonds issued in Canada. That would be in orange. And you would earn, and here we're depicting 1 year returns for owning all of those bonds in the Canadian market. And what you notice, of course, that we knew already, stocks are more volatile than bonds. So over short periods of time, the stock market can move around quite a bit. Now, Doug did walk you through how bonds themselves can move around quite a bit. You can buy a 10-year Ontario bond, and if interest rates go up 1%, you've now lost 8% instantaneously. However, you're going to be typically holding on to that bond until it matures. And so you're able to abstract or not think about the volatility of that investment. when you're going to buy, if you buy the growth fund, there will be more volatility and you will be seeing it more actively because that fund will be marked to market. It'll have a market price every day, and every year it will show up on your budget and your financial statements. It will have to be marked to market, most likely. Whereas the bonds, you could have potentially just ignored the moves and held them at their historical price. You are going to start to see movements of this new pooled fund that we introduce. Now, the important thing to understand here is if you look at things over a 1-year period, they look very volatile. But what if we were to look at stocks and bonds? So the same thing, Canadian stocks and Canadian bonds compared, but you look at them over 10-year periods. It's important to understand that this growth fund is only going to be suitable for local governments that buy into it, willing to hold on to that fund for 10 years or longer. If you aren't, if, for example, you had money that you needed to spend in 2 or 3 years, the MFA would never accept that money to put it into this growth fund. However, if you have money that you don't need for 12 years, for example, to rebuild a sewage asset, but you know is going to come to end of life 12, 13, 15 years from now, that would be suitable to put into the growth fund. You can see that stocks over a 10-year period, if you ignore the 1 year's ups and downs, tend to be positive returns and higher returns than bonds. Now let's look at it a little differently. What if we were to put stocks and bonds together in a portfolio, which is exactly what we're going to do with the growth fund. We're going to be putting stocks, bonds, and other global growth assets together in a diversified portfolio. Then we reduce risk even more. So what you can notice on this graph, if you have a 50% stock and bond portfolio, compared to, in red, a 25% stock versus 75% bond portfolio, the volatility is lower. The changes in value over 10 years is lower than on the previous graph because you've now combined investments together, and that has beneficial aspects to the portfolio. It reduces the risk of the portfolio. Let's look at this in numbers. It's very important that you understand these concepts because as counselors and directors, you are going to be approving policies that then allow your CFO or investment professional at your local government to make decisions, but you're going to have to approve the policy behind those individual investment decisions. So let's just look at this a little differently. The first column that says Portfolio A would be a portfolio of 100% Canadian government bonds. If you held that portfolio today, if you purchased it, you would expect to earn only 1% over the next 10 years. And annually, Doug talked to you about this interest rate risk. You would expect that portfolio would go up or down most of the time by no more than 4.6%. So 95% of the time, if you own that portfolio of government bonds, you're going to be expected to earn 1%, yet every year you're taking 4.6% of risk, meaning the value of that portfolio annually can move up or down that amount. So that then gives you this concept down there of the Sharpe ratio, which is simply the return divided by the risk. And you can see that you get 0.1% of return for each unit of risk by owning those government bonds. Let's look at Portfolio B. Portfolio B would be more similar to an MFA fund. For example, our short-term bond fund. It includes both government bonds and corporate bonds. And if you include corporate bonds, you can see that the long-term expected return is now 1.3%, and your volatility is actually reduced. So this is interesting. You're adding riskier assets to a portfolio. You're adding corporate bonds to Government of Canada and provincial bonds. You're adding more risk to the portfolio, you would think, yet your volatility has come down. That's because government bonds and corporate bonds don't move in the same direction all the time. And so this is this portfolio effect that is going to be beneficial when we create the growth fund, where we'll be adding other asset classes and reducing risks and increasing diversification. You could see that Portfolio B gives you 0.18 of return per unit of risk. So it's a better portfolio than Portfolio A. Now, Portfolio C, D, or E are what the growth fund is likely to look like? We don't know yet whether it'll be portfolio E or portfolio C, but just roughly, this gives you a feeling for three types of portfolios. One of them is 50-50 in global stocks and bonds. One of them is 25% in bonds versus 75% stocks. And then portfolio E is 10% in bonds versus 90% in global equities. What do you see happen as you go from portfolio C to E? The rate, the expected return grows, but of course the annual volatility grows as well, because you are now incorporating more and more equities into this portfolio. And so now your annual risk, the portfolio E, the way to read that is over 10 years, I'm expecting to earn 6.3%, but every year, 95% of the time, I will likely lose 12.9% or gain 12.9% or less throughout that year, 95% of the time. So that gives me 0.45 return per unit of risk. So we just wanted to illustrate this here. The key component here is this annual volatility. The biggest risk for local governments putting money into this fund is that you put money in day one, several years or a few months later, we have a market crash and you're going to have a negative return on this fund. And now all of a sudden you're going to forget about this idea that we invested this for the next 10 years to earn more. And you're going to have a very natural knee-jerk reaction. It's a very well-known phenomenon in the market where you're going to want to take your risk out, sell the fund at exactly the wrong time when the markets are crashing. We see this happening time and time again. We saw it happen in March, April. The markets crashed. People that had heads on their shoulders, that were calm and kept their money in the markets, have come out of this far ahead. They were able to ignore the intra-year volatility, hold on to their portfolio, and rectify and keep earning those longer-term returns. So on this slide, I won't spend a lot of time here because these are still being developed. But as I mentioned, the growth fund will be only suitable for certain local governments that have the appropriate policies in place, that have the appropriate cash flows in place, that understand and have a discussion. So on the investment side, the CFO and the finance staff, in many cases, especially for smaller or medium-sized local governments, should have a wholesome discussion with council before they even decide to enter into this fund and talk about that extra volatility and create this type of documentation and controls that would then give MFA comfort with letting smaller and medium-sized local governments enter into this growth fund. Doug, I'll pass it on to you. We're just going to talk a little bit about policies, investment policies at local governments.
Great, thanks, Peter. So every local government should already have investment policy in place, review it annually, and the procedures that go with it. And adding to what Peter just covered in the previous slides, making the necessary revisions to your policy depends on your investment strategy and may include identifiers between short and long-term investments. Moving into the growth fund requires evidencing your understanding of long-term risk-adjusted returns. And this would be present in your policy going forward. For example, if your primary objective is preservation of capital, which is really should be for all local governments, we probably have the same exact writing in our policy documents, you can still maintain this objective with a slight tweak to your policy. The terminology in your policy going forward may transition from a statement on the left of accomplished through placing funds with creditworthy institutions and diversification to the statement on the right, maintain normal value for short-term reserves and real value over the long term for long-term reserves, accomplished through placing funds with creditworthy institutions, diversification, and investing in growth asset classes for long-term reserves. What we are saying is the policies need to grow and be adjusted to match the strategies you intend to deploy. With a growth fund, for example, transparency and communication with council is critical, especially as you hold a long-term fund that will have market volatility, which is reported annually in the financial statements. So we'll go to the next one there. The inputs of planning allow you to identify risks, but also helps you to see the missed opportunities and the changes that are needed to affect future returns for the positive while reducing risk. When you identify your cash and investment needs through planning, you can then overlay the products to invest in, including what the MFA has to offer, for example, in this chart. Shown here are the various MFA pooled funds that can match your goals and time horizons. The city of Burnaby never held MFA funds until 2020. We invested them ourselves for the last 40 years, recognizing the limitations to our portfolio build and along the yield curve with the changes that have happened, and the need to diversify asset classes that are, now that our portfolio is so large, we began investing in the MFA pooled funds last year. So now we own units of the MFA mortgage fund, and we are still waiting to add more units. And we also hold units of the fossil fuel-free fund. In addition, we were able to identify that for the long-term reserves, there isn't a sufficient risk-weighted return portfolio option for greater than 10 years. That's the far right side of this chart, where you see the green, and the long-term, the box that is gray. This is critical for long-term sustainability, and then we have been discussing, and the growth fund will serve up the solution for us. So under regulatory guidelines of the Community Charter and the Local Government Act, a municipality is to maintain various reserve funds, which are known as statutory reserve funds. The municipality may also utilize non-statutory reserves to facilitate the organization's financial management. So statutory reserves are required to establish through a bylaw that is approved by council, or it is provincially legislated based on the source of the funds. For example, the city of Burnaby has statutory reserves such as the Capital Asset Work Financing Reserve Fund, yes, that's a mouthful, which funds new or replacement furniture, technology, some machinery and equipment, and capital improvements. Another statutory reserve is the Development Cost Charge Reserve Fund, which is an accumulation of DCC fees, which are provincially legislated to fund parkland acquisition and pedestrian linkages. One more example is the Equipment Replacement Reserve Fund, which is contributed to annually for the replacement of vehicles and fire equipment. Now, non-statutory reserves allow a council to establish a reserve for a purpose and to have the money placed to the credit of that reserve for future use. As shown, the city of Burnaby maintains several non-statutory reserves, such as the Community Benefit Bonus Reserve, which is funded through development projects and is used to fund future community amenities such as swimming pool, recreation center, or library. Another is the Statutory Sewer Capital Reserve, which is to provide funding for sanitary sewer capital equipment, the infrastructure replacement, and improvements. Now, with all reserves, the funds are not required tomorrow. The building of a new facility or the replacement of various equipment or capital improvements for water and sewer infrastructure is an ongoing process. Capital work and improvements is budgeted for and occurs each year, and replacement is gradual, as roads, for example, and other assets can have a lifespan of 30 to 80 years before replacement is needed, and various equipment can have a lifespan of 5 to 40 years. So we are annually contributing funds for replacement of infrastructure, improvements, and equipment for which the actual replacement can be decades away. So how do we identify those reserves? Let's take a look at the next one, Peter. The reserves indicated within the red boxes are what the city of Burnaby considers to be available for long-term investing. When analyzing all of the funds, we consider what is considered for projects within the next 5 to 10 year capital plan, and what is remaining can be invested for a longer term. The reserves for longer term investing total approximately $730 million. A majority of these funds are considered actually to be a conservative estimate of the funds that we believe we can invest for 10 years or longer, even 20 years or longer. For the anticipated MFA growth fund, however, we do not feel that a municipality should invest more than 30% of their reserves. So the city of Burnaby is targeting an initial deposit of $300 to $350 million, which will be approximately 17% of our total portfolio, and only represents 41% of our long-term investable reserves as shown in these red boxes. The message here is that being able to identify your long-term investable reserves for the MFA will be required for investing in the growth fund and for communication to your council on why you should go into the growth fund if you can. Thanks, Peter.
Thank you, Doug. I wanted to switch gears a little bit. We'll have a conclusion slide around the most important topics that Doug and I have just touched upon around the growth fund. But we have been getting a lot of questions about socially responsible or ESG or fossil fuel-free investing over the last few years. And the MFA has responded to some of the commentary and requests from our members to create some funds that were fossil fuel-free in nature. What I did want to mention here is that this whole very big space, what I call the wild, wild west of socially responsible investing, is a fast-moving space. It's a very complex space. It's one that requires finance professionals to put a social lens onto how they run their investment analysis and how they run their portfolios. And it's quite it's really not an area that has standardized yet. So the reason I'm mentioning it is that many counselors and investment professionals in local governments have been interested in the topic. MFA has decided with its trustees a few years ago that adopting a socially responsible lens that would look both at environmental, social, and governance factors, all of these factors together, and offer a fund that is a broad fund was a little bit too complicated for us to undertake at that point, although it was our preference several years ago. And so we did decide to listen directly to some members that wanted us to exclude fossil fuel related companies from some of our funds. And we have offered some funds that offer that. Let me just move to the next slide, just explain to you why this area is so complicated. So for one to do ESG investing or sustainable investing or socially responsible investing, there are many, many names for these things. The first thing you need to do is analyze the investments you own and look at those companies, those corporations, let's say, that you're going to invest in under a model of some sort. So one of the models that is being used quite a bit globally, I'd say it's become one of the standardized models, is the United Nations Sustainable Development Goals model. And what it does is it looks at 17 goals to transform the world. You have them here, reducing poverty, reducing hunger, education, gender equality, et cetera. Of course, you have climate action, number 13 would be one of those goals. And so what you're doing is you're setting up, this model will say, look, under goal for climate action, here are some sub-goals. Reduce your carbon emissions. Try to push oil and gas companies to become, to transform their businesses, to get into clean energy. Try to push corporations to change their footprint, et cetera. So there's a bunch of sub-goals within these 17 larger goals. And then what you need to do is you need to analyze each investment you're putting money into, looking at these goals. So as you can imagine, that's quite a complicated thing to do. And in order to do that, you have this enormous industry, various organizations that are trying to standardize disclosures from companies such that you can make these qualitative decisions around socially responsible investing and incorporating them into your traditional investing model. You can see that there are dozens of organizations trying to do this. And herein lies the problem with socially responsible investing. These organizations may or may not agree with the footprint of what they're looking at. So what we need to have happen over time is that there's standardization of reporting from companies. And then this idea of socially responsible investing will become much, much easier and will grow much more. So the only thing I want to leave with you is that it is a very complicated landscape. And until we get standardization, it will continue to evolve over time. So far, as I've mentioned, the MFA has offered fossil fuel-free options to local governments. We have 4 of them now that are available. Depending on your definition of what fossil fuel-free means, there would be 4 products that you could invest with MFA through pooled funds that may meet your definitions of what fossil fuel-free means. So let's just put this all together, and let's talk about what we've learned today. So first, there are only a few things we want you to leave with, and if you leave with these ideas, I think you'll be in great stead to be able to continue talking about this topic of growth funds and socially responsible investing with your own local government. So first, investment policies, the vast majority of them, and our recommendation would be that investment policies should always be council or director approved. Those policies would have objectives in them that, again, council or directors look at, decide make sense, and then that gives a roadmap to people like Doug and other investment professionals in managing the portfolio. As we said, with the growth fund being introduced, those policies will have to be tweaked in some cases, changed, and some local governments don't even have policies yet. And so we would require them to introduce policies before they can go into the growth fund. This concept of preservation of capital is absolutely critical for local governments. The problem is that while we think that by only allowing you to put money into fixed income instruments, we're achieving this, what has actually happened over time is that local governments are very concentrated in terms of their portfolios generally. So we urge you to always diversify your own investments in as many names as possible to reduce risk, picking right credit exposures. And now with the introduction of the growth fund, we will be adding new asset classes and other exposures that will help you diversify your portfolio even further. The other point is buying growth assets like equities is not necessarily does not necessarily go against preservation of capital, because remember, when you're buying a bond today, you are likely locking in a return that is below inflation. And so many professionals may argue that you're not really preserving your capital at all here. You're preserving the nominal amount of your capital, but not the purchasing value of your capital. Future cash flow projections, capital plans, and other documents are absolutely critical for local governments to do well and do right before they can start thinking about maximizing their investment returns. So very important to bring that home. And then finally, as we said, we are going to be introducing very likely this growth fund. It may not be available to all of you immediately. We're going to start with some larger members, help them incorporate the portfolio into their own reserves, think through what their policies should look like. And we will then over time be rolling it out to all of our members who are suitable to purchase this fund. And then finally, on the topic of socially responsible investing, it's a very complex area. There is a lot of confusing information out there in the press and everywhere. If you want to talk about this area more, you want to incorporate socially responsible investing into your own portfolio and your own local government, because it's something your citizens are asking you to do, please talk to the MFA. We've done a lot of work around this, and we can help you think through how to incorporate socially responsible investing into your own portfolio. Thank you very much for your time, and I think now we'll have some time for questions and answers.
Wow. Thank you, Peter and Doug, for presenting and explaining this novel investment opportunity. I'm sure we have barely scratched the surface of this vast subject, and you'll be getting a lot of questions. And on that note, we have some questions coming through right now. First one for Doug. You raise very good points about the need for investment policies. How do we get started?
Oh, excellent question. Thanks, Gabby. I think there's two very good resources. Okay, let's say there's three good resources. There's a book called Investing Public Funds. It was commissioned by the GFOA, and it was written by Gerard Miller. And it is really a great guide for any municipality on starting their portfolio, investment portfolio policy. The reason is that it identifies the different risks that are out there, guarantors, and it also gives you examples within the policy documents of how to write it and how to clarify and report back to council. The second one I would say is, once you look at this book, is that there's an organization in the US called the Association of Public Treasurers of the United States. It's aptusc.org. And they have a certification program. So once you write your policy, after reviewing it through that book, you can have your policy certified. They have 18 different guidelines and criteria. And by using them, you can get it certified and let council have a certified policy document. And then I say third because I think the MFA is an excellent resource that you can use. They have a lot of excellent staff there, and I'll let Peter cover that side of it.
Yeah, sure. Thanks, Doug. You can always approach the MFA. We are reviewing and helping local governments and regional districts look at their policies, and we have even some templates of policies, from simple ones to quite complicated ones. I should add that the simplified policies probably would not be eligible to get certified, but the more complicated ones, then you could go ahead and get certified the way Doug suggests.
Great. And Doug, if you wouldn't mind, please sending along the titles of those books that you had mentioned. I'll be sure to put it into the documents section or relay it to the audience in some manner. Thank you so much. And the second question that's coming up here is for Peter. Why wouldn't local governments be given the authority to invest directly into equities or other growth type assets?
So another great question. Doug talked about how the city of Burnaby approached through UBCM the province and asked for those powers to invest themselves in multiple asset classes. And you know, the reality is that a city like Burnaby could very easily have not managed those funds internally, but could have hired an external asset manager to manage that type of a portfolio for them. But let's be frank, there are just under 200 local governments in BC, ranging from several $1 billion of assets, like the city of Burnaby and many of the metro municipalities. But then you have many local governments, over 100, that probably manage $5 million or less. And so the level of knowledge and sophistication will vary quite a bit between those local governments. Finally, I'd say that, I mentioned that Doug would likely not manage that type of portfolio in-house if that were allowed by legislation, because Doug is an excellent investment professional. He's done great things for the city of Burnaby, but they have all been with fixed income instruments, because so he's a fixed income expert. And I'd say generally, all local government investors are quite knowledgeable, different levels of knowledge, but quite knowledgeable about fixed income investing, but don't have much expertise with equities, and even less expertise with, international asset classes.
Yeah, so this is really, truly a vastly different product where some trailblazing will be necessary. Do you expect that there will be hard limits or other limitations as to which local governments have to adhere to, and how much money a given local government can invest in a new growth fund?
So MFA is currently discussing this idea with the Ministry of Municipal Affairs and the Ministry of Finance as well. So we've been having discussions with them for quite some time. They've acknowledged that we have the authority to introduce the fund, but given that the province is responsible for safety and soundness of the local government sector, they're of course very interested in making sure that this is done in a very professional manner, and that we're not introducing risks into the system that they know of. So I would expect, I don't know where they're going to land on this, but I would definitely expect that they're going to impose some limitations, certainly in terms, for example, of the percentage of assets that a local government would have that could be invested in this type of a product. I don't know where we're going to land on that. And also the size probably done with the size of portfolio or size of population of the local government. They're going to probably want to first see us roll out the product with the larger local governments, and then over time maybe allow us to roll it out to the entire system. I will tell you that both our ministry and MFA creates products that are suitable or for some subset of local governments, but that are really created for all of local governments. And so our intention at MFA is to make sure this fund is available for all local governments over time. But I'm sure that there will be initially some limitations, and it may well be, a few years before some of the smaller local governments are allowed to enter into this fund.
Right. So there'll be some examples to follow. We have time for one more question. Is there a mechanism or mechanisms that you can think of that would ensure that if a municipality decides to invest into the growth fund today, that a new council in the future directs its finance staff to pull money out early?
Yeah. So the first thing, I'll take this question, Doug, if that's okay. The first thing I would say is that you'd never like to see council direct staff to make any investment decisions, whether it's buying or selling. Directly direct staff. Remember, we talked about the policy. The policy is where council decides on objectives, appropriate risks, and all sorts of other parameters that then people like Doug can use to appropriately manage those reserves. So that's my first point. Having said that, councils can tell staff to do things. And so, the biggest risk, as we mentioned in this presentation, one of the biggest risks of this fund is you make a decision to buy it for, say, 12 years, and then you have a market crash 3 years later. You have a negative return that year. You haven't crystallized those losses. They're just paper losses. And we talked about how if you can ignore those losses over time, you should recoup that investment and do well over time. Is there a way to, this is really a question, can today's council handcuff, or can council today sort of bind future councils? And the answer is that it's difficult to do that, right? When a new set of elected officials comes in, they can take the view that the growth fund is a risky investment for their local government. And while I can understand that they may take that view, our hope would be that they wouldn't take that view because that particular year the stock market crashed, right? So I think the best mechanism that we can think of, and we're in discussions now, again, with the ministries and Burnaby and MFA have talked about this, really the best mechanisms are to be extremely transparent and have public disclosure and staff to council disclosure about the fund before you come in, and agree that that fund will be held for the long term, and have it be publicly stated that all the risks were considered, and that the city of X and its council decides today that they will be putting the money in for 12 years. And hopefully then future councils will be aware of that public discourse and will not come in midstream and wreak havoc with what was probably a smart long-term investment strategy, but destroy that strategy midstream.
Super interesting. So there's got to be some handing over of the baton there to guarantee long-term success. Well, thank you very much, Doug. Thank you very much, Peter, for this very interesting conversation, and for the Municipal Finance Authority for looking out for us.